scramblings out there now. If you ever want to look at them, or if you ever miss a class, want to listen to something. Okay, can't sleep, whatever. So let's talk about a few of these things. Special problems, special stuff. Is that the same stuff? Okay. Special problems in the statement preparation, adjustments to income. So these are some of those. Okay. Accounts receivable net, other working capital changes, net losses, gains. Okay, significant non-cash transactions. Okay, so anyway, these adjustments to net income, things that we see all the time. You guys know, here's the basic rule. Anything that either debits or credits an income statement account, right? An income statement account, where the other side of the entry is not cash, you need to worry about it. Make sense? That's basically it. And there are lots of those things, right? A lot of times you'll do this. You'll accounts receivable, and you'll credit sales. You'll debit sales or some sort of revenue, and you'll credit unearned revenue. The debit, why I wrote debit on those. The debit and expense, and you'll credit accounts payable. Okay? You'll, you'll debit and expense, and you'll credit prepaids. Everybody agree with all these? Deferrals and accruals, that's all it is, right? There's no cash. When does the cash happen? With this one, when you collect it, what do you do? Debit cash, credit accounts receivable. With this one, what did you do earlier when you collected it? Debit cash and credit unearned revenue. Am I right? What about this one? Debit accounts payable or salaries payable, or whatever it is, some sort of payable, right? And credit cash. What about this one? Debit prepaid and credit cash. So the cash flow is not the same as the revenue expense. We know that, right? How does this one get reflected in cash flow? All those, they all kind of go together. Up in operations, right? Because all the reason that you have all these accounts is to operate your business, right? You're trying to record revenues and expenses. True? Okay, so it's all up in operations. And how do we do it if it's the indirect method? The change in accounts receivable, right then? Right? To adjust for what? The difference between the debit to accounts receivable and the credit to accounts receivable, which is the difference between cash flow and the sale. True? For the year. That's what we do. Okay? On the unearned revenue, same thing. Change in the account reflects what? The difference between the sales we recorded and the cash we received. Okay? How about on the expenses? It's the difference between the expense and the cash we paid out, right? When we take the change in accounts payable. Everybody agree with this? Oh, you need to add inventory to that one too, don't we? Because there's this entry. How does that one get in there? There's no cash. Well, what happens? The difference between cost of goods sold and plus or minus the change in inventory, plus or minus the change in accounts payable relating to cost of goods sold, right, the inventory. That totals up to the amount of cash that went out to buy inventory. It does, doesn't it? But how do we handle all of those with the indirect net? It's kind of clever. Just write down the changes in the account, the net change in the account. What do you do if it's the direct method? For sales, what would I do? This plus this, plus there's another way that you can record sales, right? What's that? I did that. Did you realize I did that backwards?
Yeah.
No, why didn't you say anything? I'm standing too close to it to see it. Yeah, it's backwards, but I'm going to say it. All right, thanks. Okay, anyway. What should it have been? Unearned revenue, of course. Sales. Okay. Anyway. I got that one right, don't I? Yeah, that's close. Okay. What would you do if you're using Let's just do this. You're using direct method. Real simple. What do you do?
See what's the beginning and ending accounts receivable. Yeah, that's all it is.
Remember this when we did cash to accrual? Accounts receivable, beginning, ending. The change is either a debit or credit, right? All we gotta have is the change. Unearned revenue, what would you do? Beginning, ending. Everybody agree with that? Okay? And the change is either a credit or a debit. Of course, we covered that. Okay? And sales, it's of course whatever the credit is on our income statement, right? So I've got the changes in each of these, and I've got that, and what do they all total up? If I make the debits and credits equal each other, the net debit is to what? Cash. That's the process, and if you see that, you got it made. And for anything, if you see it, what accounts go together, right? Okay, so if I was converting, the example that we used yesterday, they only had accounts receivable, I think, right? But if you have unearned revenue too, who cares, right? Just pick them up. Is everybody staying with me on this? Not a big deal? Not a problem to do this? Let's do cost of goods sold then. How would cost of goods sold work instead? What accounts would you work with your cost of goods sold? Oh, I think inventory becomes cost of goods sold. I think when you buy inventory, it's accounts payable. And when you pay for the inventory, you pay for it with cash. What do you want on the cash flow statement if you're using? Well, if you're using the indirect method, what would you do? Show the change in this one, show the change in this one. This one is included in net income, right? Just like sales is. So is the cost of goods sold, all the expenses are, right? So what I want is the amount of cash that went out for this, right? Well, what are the entries here? You got a beginning balance. You're gonna work your way down to an ending balance. What do you do when you buy inventory, of course? Just use what you know, guys. You got it made here. It's just not hard. What's the deal? Debit inventory and credit what? Almost always accounts payable. Could be some of the cash, but we don't care, right? Okay? Doesn't make any difference. It's still gonna net out to the total. Okay? You have a beginning balance here too, don't you? You have an ending balance here too. What's the deal then? You pay it, right? Is that true? What's this credit here? Debit inventory, credit accounts payable, right? And then how much we pay is what? This one? That's true, but I don't think I have that number yet. Why not? How do I know how much I bought? This is what I did buy. But what did happen to it? I sell it, of course, right? Comes out of here. So how's this going to work? Where does it show up in the cash flow statement if I'm indirect? I have cost of goods sold. It's included in the net income and net loss, right? Oh, by the way, there's a special situation when you have a net loss. What's the special situation with a net loss? Instead of adding it under operations, you subtract it. If you pretend nothing changes except for cash, and your one account you're working on, right? The change in retained earnings for a net loss is a debit, so what must be the effect of cash if nothing else changed? That's kind of what you do. You just pretend nothing else changed. What is it? Credit cash. Less cash, put it back around. What is a net income? It increases cash, of course. Look cut it through all the way, right? Is that really true? Of course not. Got a whole bunch of accounts going. Hundreds of accounts sometimes going. Okay, anyway, so this cost of goods sold is included in that income. Well, then what would you do in the indirect method? You show the change in inventory, change in accounts payable, and when you add up the change here, plus the change here, plus the cost of goods sold, what do you get? Cash going out. Right? You know what all the transactions are. It's just not a big deal. Direct method, what would you need to do? Take the cost of goods sold and do what to it? Same thing. Except you don't write it on the face of the statement. It's the same process. Cost of goods sold plus or minus the change in inventory, right? If your inventory went up and your cost of goods sold is whatever it is, and you have no change in accounts payable, what must be the case? The cash that went out would be the increase in inventory plus the cost of goods sold, right? If the account, and then what would you do with the accounts payable? Plus or minus the change in that one, right? So the three have to go together. Because what could happen? I can buy stuff and not pay for it. I'll have more cash, right? Accounts payable goes up. Or I can pay for more than I buy. I have less cash. Accounts payable goes down. Okay, so cash flow is different than cost of goods sold. Big deal. Okay, and you can think through any of them, then you can. Doesn't matter which ones they give you. I guess maybe that's all obvious. What's different about depreciation and amortization? Debit depreciation expense, credit amortization expense. Is there any cash? No. I'm sorry. Debit depreciation expense, credit accumulated depreciation. Debit amortization expense, credit the asset, right? But anyway, what's happening? Nothing to cash, right, guys? So it's in the income statement, but nothing happened to cash. So what do you need to do with the indirect method?
Add it back to the.
Add it back. What do you do with the direct method? Nothing. Right? Because you're not starting with income. Got it? Don't have to bother. Should come up with the same answer either way. Okay, so not a big deal, I guess. Okay, and then they took about the amortization of bond discount or premium. We didn't do that one. We did principles, but sold. What's the deal there? Amortize a discount. What does that look like? What balance is it? Is that a debit or credit balance? In discount and bonds. Debit or credit? Discount. Bond payable, liability, big credit. What's the discount? The debit, right? Okay. It's the discount on the bond. If you use it, it's the debit balance. How do you get rid of it over time? You credit it, right? And you debit what? It increases your debit to what as you amortize the discount? By what is more than the cash flow? You know, what else these guys amortize the discount? Don't you get rid of the discount? Credit until it's gone. Don't you credit cash to the amount of what you're paying? Interest. Okay, that's the interest paid. This is the interest expense. When you're discounting, what's happening? The discount adds to your interest expense, right? What's the deal? I got $1 million bond. I issue it for 900,000. That extra 100 is going to be interest I pay over the term of the bond, right? You borrow 900,000, you pay back $1 million. That's extra interest of 100, right? Plus you're going to pay the interest that's stated on the bond. Everybody agree on that? Premium is just the opposite, right? You got $1 million bond. I issue it for 1.1 million. That's 100,000 less interest over the life of the bond. Would you agree with that? You get 1.1, you only pay back $1 million. Come on, it's less interest, right? So we're going to amortize that. That's what you're doing, right? So it's easy to learn how to do this stuff and not know exactly what you're doing, isn't it? Why am I doing this? What's going on? Okay? So sure. So as I do this, what ends up in the income statement? This. How much cash went out? This. What do we need to do? Oh. What do we need to do? Our interest expense is too high in this case, right? From a cash flow standpoint. So I've got to adjust for the bond discount, don't I? The amortization of the bond discount. Just like amortization of a patent, just like depreciation of building equipment. Same deal, okay? So in this case, what's going to happen? My cash flow is what? Less than the expense. I'll have to add that back, won't I? Okay, just like depreciation expense. What if this thing had been instead, though? How about if it was a premium? What's the journal entry for a premium? You still have an interest expense, right? But now the cash going out is more, right? Because it was sold at a premium, right? And your interest expense, and you're going to debit what? Premium on bond payable. What would you have to do with this one? cash is more than the interest expense. So if I'm doing the indirect method, what I have to do is this amortization of a premium. I've got to deduct it, don't I, to get down to what the real cash flow was. Say it right. Yeah, more cash went out than the interest expense. I have to deduct it, wouldn't I? It's kind of like a gain and a loss on the sale of an asset, isn't it? Does it seem counterintuitive that the gains, what do you do with the gains? Subtract it. That's so you don't double count it, right? You don't want the gain in net income and then leave it in there and then put the gain down below when you're doing investing activity or financing activity, right? Depending on what the gain was on, right? You don't want to double count it, right? So we subtract the gain. Loss is just the opposite, right? Because the loss is adjusting, right, down below in investing if it's an asset, right, and in financing if it's on debt, right, retiring debt. Everybody agree with that? So just let yourself think through it. It all makes sense. Okay. So on a premium, you're going to have the same thing going on, aren't you? The cash here, right, needs to be adjusted by whatever you amortize on your premium. So that's all they're saying. So how many things fit in this category where the cash flow is different than the revenue or expense? A few, huh? Oh, by the way, what if I'm doing direct method with this? I just show the cash that was paid for the interest. No big deal, right? It's clearer, isn't it? Okay. Right. But how would you get the cash that you paid for the interest? Same way. You have to calculate it either way, don't you? Okay? And that kind of makes sense? So instead of going through specific examples, probably better just to talk about them. What about post-retirement benefit costs? On page 1435. You guys are well aware that there could be a difference between the cash that's paid out and the expense, right? Guess what you have to do with that? Adjust for that exactly the same way. So they haven't shown you examples of everything there, so they've got a list here. So the company must adjust net income by the difference between cash paid and expense reported in computing net cash flow from operating activities. And notice these are all hitting operating activities. That's because the revenue or expense is in operations, right? Okay. So, changes in deferred income taxes. Where should that go? Isn't deferred income tax a long-term liability? Yeah. Wouldn't it suggest, some people debate whether or not it's a real liability, right? Because the discounted present value of it might be nothing. But we don't discount it, so it's a real liability. Only because we don't discount it. If you're going to wait enough years to use your deferred income tax asset, or your deferred income, usually it wouldn't be the asset, if you plan it to use asset, but your deferred tax liability, you can wait forever to pay it, right? What's its present value? Depends on the discount rate, of course, but it's going to be low, isn't it? Okay. So some people would argue we shouldn't even record deferred income tax liabilities, and a lot of analysts just ignore it. It's not a real liability. Keep, assuming going good, we're going to keep doing a good job. We're never going to pay those taxes. Well, we are. We're not going to pay them for so long. The present value is not. It might be right. Okay, might be right. The tax rate on my retirement plan, you guys, if I never take the money out of the retirement plan, for me, is 0. True. And if I find a way to pass it to my heirs without them having to pay tax on it, which you can do, of course, it's 0 anyway. So what's the deferred income tax on my retirement plan? Where are they putting money in tax free? I don't know. If I live long enough, it's going to be pretty high. You'll have to pay tax on it, right? If I take it out, it's money out, okay? But if I drop dead, it might be good, huh? Save a lot of money. You win. Yeah. You win if you die young. Yeah, I guess. Okay, too late for me. All right, anyway. So we got that one. And where do they put it? They don't put it in liabilities, do they? Not down in financing. It's not long-term liabilities. Why not? Because income tax hits the income statement. So the idea is, we'll put it up there. I don't know if I agree with that or not. Maybe it's a long-term source of financing. Maybe it should be down in financing. Don't do it that way. Don't do that. Okay. All right. What's the deal on the equity method? What do you do in the equity method with income you've got and with dividends you've got? How does that look, you guys? Let's have a fun one. So what the journal do review, equity method versus market value method. Hey. How does it work? So I was doing market value method if I was doing equity method. Or just think about equity method versus cash flows. What do I do in the equity method when I record income from my affiliate? Let's say they make $100,000 in a year and I own 40% of it. How much should I earn? 40. Yeah. Okay. So what I would do is debit investment affiliate, right? For 40? I think so. And I would credit what? Income from affiliate. What I just do to my income statement? I just increased my income by 40, didn't I? Any cash flow? Of course not. Okay. How about when they pay me a dividend? I pay myself a dividend. Let's say I pay myself, my share is 10,000 of the total dividend, right? So I get debit cash. Yeah. Okay. Does that hit income? No. Okay. Everybody got the idea? So 40 and 40, or 40 and 10. Yeah. So what I've got is cash flow of 10, income of 40, right? In my income statement, I show 40. So what am I going to have to do, obviously? If I do a cash flow statement in these guys. Increase in investment in affiliate would reduce, right, from net income, right? With the indirect method would reduce down by 30, wouldn't it? You got to take that change. You look for all of these things. So think of all of the journal entries where this could happen to you, right? And by the way, you just keep working until what? You're down to changing cash. What are all the things? Now, if you have enough of these, does the worksheet start making some sort of sense? Well, maybe. Even then, I think what I do is I just very meticulously go down line after line after line on the balance sheet and on the income statement and identify, okay, is this expense the same as the cash flow? Is this expense the same as the cash flow? And if it's not, and the same with the revenues. And if it's not, what do I do? Is it included in the current asset or current liability? And so, cool. If it's somewhere else, right? Why is it cool if it's in a current asset or current liability? Because you're showing the change you took care of it all, right? The indirect method. With the direct method, it'd still be okay because you'd analyze the cash flow by going through those current assets and current liabilities, right? What do you do when it's hitting go? What's the thing about investment affiliate? Current or non-current? Investment affiliate, you own more than 20% of the company? Come on, what is it? Long-term, yeah, so it's non-current asset. So because it's non-current and it's hitting the income statement, you have to be more careful, that's all, okay? So again, if you're using the indirect, I'd have to take that 30, wouldn't I? And subtract it out, because it looks like I have 40 coming in, right? If I look at my income statement, I have 40 income, and really only had 10 cash flow. True? What if I'm using the direct method? It's not a problem, right? They never treated it like it was cash flow. It's not, all I'll do is I'll put it in the 10. I'll put stuff into that. Okay, it's real cash flow. Okay, dividends from affiliates. We'd have to show that. I guess we still have to handle it there, but just the 10 side. Not as complex. Okay, that's a big deal. Okay, anyway, by the way, if this was market method, what would we have done? You got available for sale securities. It would be market method, right? What would we do with the increase in the what would we do with the increase in the account? Let's say this ownership share was less, right? So 20% or something. What would we do with the income from our investee, right? Well, not with their income, you do nothing with their income. But what do? The change in market value goes to OCI. So what you do is you do either the increase or decrease in market value, right? So you'd either increase or decrease the market value, which would be an available sale, right? Long term or short term. And then you would have either a debit or a credit to what? OCI, wouldn't you? Other comprehensive income, accumulate other comprehensive income on, gains and losses, unrealized gains and losses, unavailable for sale securities. So you've got both of those things moving. But what's the nice thing about that? There's no cash there, and it also does not hit net income, right? And we do nothing with this earnings, right? You wouldn't do anything for the earnings, of course, right? And then, oh, by the way, what do you do with the change in market value if it's an affiliate? Nothing, right? You got nothing going there. What do you do with the dividend here, which makes life really nice? What do you do?
Cash
Yeah, and guess what? That is cash that goes in, right, to the cash account, and it's income that goes on the income statement. And what would you say? That's nice, right? If I'm using the indirect method, I have nothing to do. If I'm using the direct method, what do I have? I'm using the direct method. I just have to make sure I picked up the 10 and put it in right. That's it. Good receipts. Gotta get it in there though. Okay. So there are some difficulties, I suppose, with both of them. Okay. Losses and gains, I guess we've talked about that. Avoid the double counting. Let's see. We talked a bit here about it, unrealized gains and losses. That's what that stuff is. What about in stock options? What's the journal entries for stock options at the bottom of page 1436 there? What is the journal entry on what typically happens? Recall that share-based compensation plans and companies are required to use the fair value method to determine total compensation cost. Recognized as an expense in the periods in which the employees provide services, okay, so they debit compensation expense, okay, and paid in capital stock options is often credited, right? Company didn't give cash, okay, they gave a stock option. Therefore, the company must increase net income by the amount of compensation expense from stock options in computing net cash from operating activities. If you're using which method? Indirect, because it's in there. What if you're using direct? Don't worry about it at all, right? There's no cash flow, okay? Unless to give the stock, option, they're paying out the cash through the profit accounting. Then obviously you have to pick up that part. Okay, so good. Then they point out that, well, gee, also has the tax effect of that thing, right? No cash flow going there either. Okay, so fine. Yeah, extraordinary items. Big thing there is for anything that is what? A non-cash item that hits the financial statements in any way, or the income statement in any way, you'd have to consider it, wouldn't you? Okay, that's all. If you're using the indirect method. Okay. I think they kind of overstate some of this stuff. If you go over on page 1439, I think suggesting that WorldCom and Enron and other scandals could have been found if we really paid attention to a cash flow statement. And I don't know. I don't know if that's true either, any more than looking at the income statement, looking at the disclosures in the notes. In the next chapter, we talk about disclosures on Enron. The woman who blew the whistle supposedly on Enron, although it's questionable in my view. She was an employee of Arthur Andersen, who worked in a consulting practice. And then she left Arthur Andersen and went to Enron. And she was making a really big salary to help them structure deals. And then she claims that what she did, think of that relationship, right? Doing well on both sides of this deal. Then she goes in, so I don't know if she's really the hero or not. I don't know how I evaluate that. She helped write the book and make some money off of that, though, too. But anyway, then they made a movie about it. The smartest guy was in the room, right? Maybe you've seen that. It's a good thing to watch. Good thing to watch. And it might be fairly realistic. It's dramatized fact/fiction, right? But anyway, she said that the way that she found this when she testified before Congress, She said the way she found it was by reading financial statements. And you know what? You go back with hindsight and you look at their financial statements. Yeah, you could read it. Massive increase in assets, massive increase in debts, and no substance behind the transactions. And it's pretty much disclosed in the financial statements. These special purpose entities, the profits that they were generating, but these special purpose entities, they kind of talked about it. So you got enough that you could have been signaled. I think it was that people didn't really want to watch, didn't want to pay any attention, didn't want to notice. Everybody's making a lot of money. People buying and selling the stock are making a lot of money. The stock's going up. People working at the company are making a lot of money. They also they state that these poor workers that work for Enron, and they were now millionaires because they invested in Enron stock and they got stock bonuses from Enron. They never sold their stock. They never diversified their portfolio. It was making too much money to sell it and buy something else because nothing else earned as well as Enron did. And of course, then it turned out to be a pyramid scheme, a scam, right? It didn't really exist. And then we were supposed to feel sorry for these people who were living extremely well off of stolen money. If it's too good to be true, what would you say, guys? It might be, yeah. So if you have an employer that gives you a whole bunch of stock and you think that maybe things aren't real, at least have enough sense to sell the stock and buy something that is real. And they all would have stayed millionaires had they done that. But they were too greedy to sell the stock. And even if they were still naive, if you have $10 million and you still don't understand the market and how things work, and you don't know what diversification is, do you have enough money to hire somebody to manage your money? You bet. You don't have to just sit there and hold it. So I have a whole different view on these things about who might be the victim and who might be responsible. But this is what's really horrible about this. In the subprime loan thing, I own stocks. I know I did because I'm widely invested across, mutual funds, right? Basically is all it is. So I own some of all of it. So I own stock in companies that, wrote subprime loans and stole that money from investors who invested in those. But I probably also own stock in companies that invested and then lost their shirt, right? Because they got sucked into the scheme. So I bet I'm on both sides of the deal. I bet I made stolen money, and I bet I had money stolen from me. And you know what? I don't know how much I stole versus how much I lost. And that's the problem with this. We don't know. The only thing we know is people who bought a house that they couldn't afford and lost everything they had. Yeah, they got taken advantage of, but then they got to live in a house that they couldn't afford. And should they have known they couldn't afford it? No. So you look at all these things. So read through more of it, right? Look beyond when you start looking at these things. So does cash flow help? You bet. Can you make huge profits and have no cash? Yes. How can that happen? What goes up? You start a new business. You guys, Tuesday back there, you get together and you start a new business. What's apt to happen to you when you get it going if it really takes off? What are you going to be doing? Opening new stores. Costs a fortune, right? You're going to be buying land, building equipment, or you're going to be leasing and paying upfront lease payments. What else is going to happen? You're going to be hiring all kinds of employees. They're not going to be very productive at first. You're going to be training them, and that's going to cost you a fortune. What else is going to happen when your business is taking off? You're going to be building inventory, putting it into those stores, and you have to finance that inventory, right? So either you pay cash out, so you got a big cash drain, or your payables are going crazy and your credit rating is going to hell, right? And then you're selling to your customers, of course, on account so you can get them to buy more, right? And your receivables are going up. So imagine this world that you're living in, right? Can you run out of cash? You bet. So in a new startup business, would you expect cash to be disappearing? Yeah, you would, and you try to control that as you go, right? What about a mature business and their cash starts just disappearing? Oh, that's a whole different animal. What's going on? Is somebody just milking it? They're going to close it down? What's going on? Or are they really in serious trouble? Right? Now they're closing stores and losing money that way, that sort of thing, right? So it depends on at what stage the business is in, okay? But to suggest that, oh, gee, it's not what it seems, well, yeah, if you paid enough attention. Some people they do all those ratios and cash flows, I think they're worthless. Because I think you can manipulate it too much. I don't like the cash flow. You guys know that when you have me in principal account. That don't trust. It just doesn't make any sense. It doesn't mean much.
Do you need to manage cash? Yes. Do you need to not run out of cash? Yes. But what predicts future cash flows better? How much cash you're generating this year, or how much revenue less expense you generate this year? I think it's the accrual basis income. That's predicting your future cash. If you follow GAAP, now, if your receivables aren't collectible, that's a whole other story, right? Could you find out that your receivables weren't collectible? Where would you look to find out that your receivables hadn't been collectible? Tell me the places you could look. Can you look on a cash flow statement? Sure, I can see the increase in receivables on a cash flow statement, but you know where that came from? Where did they get the increase? From the balance sheet, the beginning and ending, right? I can look at the balance sheet and I can see the receivables are not working well. Can I tell in the income statement that they're not collecting their receivables? Only if they tell the truth in bad debt expense, right? If they're following GAAP, yes, I can tell, because bad debt expense would be ballooning if they're not collecting those receivables, right? You'd expect to see that. What if the receivables are ballooning, they're getting really big, and there's no bad debt expense? Very little. Is that possible? Sure, if the business is growing fast enough and they're all collectible receivables, that could be possible, right? When I was at Ostrom Restaurants, a little Ostrom story for you, we had pretty significant sales for a little tiny company, right? And they're pretty big. And we had almost no bad debt expense every year. When I first went in, I almost went crazy. I looked at it and said, my gosh, you got millions and millions of dollars, not a lot of millions, but a number of millions, of sales for a little tiny company, and you had no bad debt expense. Why don't you have any bad debt expense? And the owner comes and says, I don't know. I'm not kidding. I'm not kidding. So I started investigating. I talked to the marketing manager. He says, why aren't there any bad debt expense? He says, well, I don't know. We don't really have any. And I said, well, are you sure we don't have any? And he says, yeah, we don't have any. You know what customers were? You know who Safeway is? Like Kroger on the West Coast, okay? Safeway, right? And Fred Meyer, which is now owned by Kroger, right? And then they had huge produce houses that had been around forever and were extremely stable. That was almost all their sales. Oh, and then the U.S. government for canned goods. That was a big one too, right? So does the U.S. government not pay? Pay, right? They get your price way down so you don't make any money. But they do pay, right? It's true. Discounts and everything. And then, do large, stable companies pay? Sure. But you know what's funny is that we got a new marketing manager and he decided he'd like to go to Hawaii. And he decided it'd be really fun to sell stuff in Hawaii. And he got these people that he met over in Hawaii having fun, right? And he got them to handle our fresh product for us and put them out in the stores. And he's telling me the whole time, these are blue chip folks. They're the same people that we do business with in the States, only they're in Hawaii, right? It's the same comparable to businesses. Unbelievable. Suddenly we had bad debts. He was just giving them those mushrooms. We didn't know he was, but he was. And I was recording sales, and I was recording cost of goods sold, and I was recording a really nice profit. Even with the freight for fresh mushrooms to fly into Hawaii, these were for people who had money in Hawaii, obviously, right? They could pay a fortune to get this stuff flown in. And, so we're sending them over there. Well, they didn't care what they paid for them. You know why? They weren't going to pay us, right? So I didn't let him go very long. As soon as they were, immediately, we had 2-day terms. As soon as the checks didn't start coming in, I'm all over, like, what is going on? So we didn't even get a recorded sales for 1 month. You gotta stay on top of stuff, right? All of a sudden, we had massive bad debts, and all of a sudden, he didn't have a job anymore. He was gone. Maybe he got a kickback from him. I don't know what happened. I don't know where the mushrooms went, right? Who knows, right? They just disappeared on airplanes and went over there somewhere. I don't know what he did with them, right? I hope he made a lot of money because he screwed his career a little royally, right? And he got fired, and we certainly weren't going to recommend him someplace else. So he managed to lose a couple $100,000, more than his salary was at the time. It's a long time ago. More than his salary was at the time, right? With one deal, just a bottomless valve. So you monitor this stuff. So anyway, yeah. So what do the numbers mean? I think paying more attention as it's going really works. But yeah, when you're outside and you're reading the statements, put it all together. Okay, what's going on? Just ask questions. Why does it happen? Why does it happen? What's going on? So anyway, supposedly we could have told, and yeah, with hindsight, we probably could.
Were you and Arthur Anderson for months?
Oh no, I was with Arthur Anderson from January of '73 for a year and a half. Yeah. And then in Washington State, you only had to have 1 year in public accounting to become a CPA. And I'd gone down to California. I transferred from started in the Seattle office, and it was too slow for me because it was like new area for the kids. Anyway, so it was too slow. It took you 3 or 4 years to make senior because it was just too stodgy, slow-moving economy at the time. Boeing was having trouble. Anyway, not really, but it was slowed down some. And so I went to San Jose and went from being an inexperienced assistant to an experienced assistant. Been there, I guess I've been with her for maybe 6 months. And then I hated San Jose and got divorced. So my wife at the time hated me. And so anyway, we went back. Actually, I guess it was a divorce at that point. We went back to save my marriage. Anyway, and that's when I went to those commercial funds. And then I went back into public accounting. I don't know, after 3 or 4 years. Don't keep a job, you guys, in your career. That's my advice to you. Keep the job as long as you're learning and you're having fun and you're getting well paid. And when any of those things stop, move, and you'll get a big raise. You're going to keep learning, right? Your raise is coming, right? Keep having a good time. If you have a good time, you'll get a lot done, and you'll get good raises. And then move until you don't feel like moving anymore, right? This is the longest I've ever had a job in my life. It's 18 years that I've been in government. Prior to that, I don't think I made it more than 4 in any spot, including universities, because it quit being fun. When I was in Indiana State, it says you're really leaving after 4 years. You'll be up for tenure next year. I didn't say it, but I thought, I don't want tenure near that. Your skill sets, you guys. Your skill set. I want to be there for the rest of my life, but no, that crap, right? So, and not a horrible place. They had nice students. They had nice faculty. It wasn't fun, right? This place is fun. You work yourself half to death here, right? True, you do. To work you guys this hard, I have to work hard, right? I don't have to do anything. I just have to put in a lot of time. Worry about it. So, yeah.
You should put some of your stories in the petitions.
Yeah, that'd be fun, wouldn't it? Yeah. Anyway, so
what keep things?
Yeah, what keep things. They aren't serious. I mean, you want I'll listen.
It's a tornado.
Really?
The weather's bad.
Yeah,
it's
it's a storm. Yeah, they said it good.
It's bad. We don't know how bad it is.
I guess you have to go outside. Yeah. They say emergency has been reported. We're gonna go outside and get hit by a tornado. That's what it says. I think that way's the way out. That door's not open down there yet. I think it's safe to leave your stuff in here. I wouldn't leave a purse, but money I would not leave, but other stuff. It's one of those new productions, isn't it?
He said he would. I don't doubt it. Alright. She started Monday or she started? They're trying to get out. Yeah, sure you're trying to get it all.
We survived. Just watched it. I'll leave it on the table up there. Good lock in town.
Are we done?
I guess so. Pretty. You guys were talking about losing those kids there. It made me think of, I used to go to Nicaragua a lot with students, MBA students. We were coming back one time, and it's really late at night, and everybody's really tired. And they go through customs. And I bet this is before all the terrorist stuff, so customs was not a big deal. But still, you're going through customs. And we had these two students, and they happened to be from France. So we had these exchange students here. And they made some sort of a smart, first they had an accent, they're going in through customs. And they're coming from Nicaragua into the US, right? And so, and they got French passports. They made some sort of a smart ass remark of some kind, I don't know what it was, to a customs agent. And they disappeared. And then by myself, I don't know, 25 students or something. And we all get through, and then we're doing a head count, who's there, and they're not there. And I can't go in again, because I cleared customs. And they won't let me know where they are, who they're with, or what they're doing, or anything about it. They just disappeared on the way through. Luckily, one of the students came close enough that they observed that they had done this, and we're getting all sorts of difficulties. They got kind of hot about it, apparently, and talking to this customs agent. So they ended up under arrest, of course. And so, anyway, and then of course we got to make a connection to a flight where, I don't know, Houston or somewhere, I don't know where else. Miami, maybe, probably Miami. And so because it's more difficult. And so then finally they're putting us on these little tram things that drive us out across the runways to get to our plane, right? Because there's enough of us that, they're holding the plane for us now. And they just stayed there. So then I stayed with them, right? Well, I stayed with them. I stayed outside, waiting for them. Everybody else went home. And they're wonderful. I was thrilled. But anyway, so, you're there in the middle of the night. And I'm sitting there just waiting to see what happens. So finally, one of the customs guys took mercy on me. And he went and found out what was going on. He wasn't supposed to, because I can get fired if you tell anybody I did this. Don't say a word, So he went and found out what was going on. He comes back and says, "Oh, there's a couple asses." Well, I knew that. I told you that to begin with. And I've been in a couple weeks with them, So anyway, so they finally just let it go. They came through. We had a later flight. Whatever. So yeah, you can lose people on these trips. And I'll tell you, that was real stressful. So and luckily the last, it wasn't a real complicated flight. We just came from Managua to Miami, and then from Miami to here. I think it was no detention. And so I knew they'd get home. They got on the plane and they left, and so ended me with them. So after a couple of weeks in Nicaragua, they didn't need anybody. You can do anything after going to Nicaragua for a couple of weeks. That's a really good experience. So I wasted the rest of the time. You can leave now. Yeah. That's kind of a fun one. Yeah, if you write a book with all these stories. Yeah, they're all recorded. Yeah. I guess we just recorded that stuff. I don't know. Who knows?
Oh, I'm going to work. Yeah, no way. I don't like it.
See you guys. Keep working. Keep working. I don't know if it's all that important to keep that hour 4 minutes.